Hello, everybody. Thank you today for joining us for our webcast on why workforce housing remains the most investable CRE asset class. Today, we're joined by Danny Catton, Managing Partner of Capital Markets of PIA Residential. Danny has more than 15 years of experience in real estate. He has acquired more than 900 single-family and multifamily units and has extensive knowledge of the different variables that affect the market. He was instrumental in the financing and refinancing of PIA's portfolio and was responsible for structuring more than $140 million in non-recourse debt. Just a little bit of housekeeping. Today, we are definitely excited to get questions from the audience. If you have them, please put them in the Q&A box located on your screen. With that being said, I'm going to hand it over to Danny. Danny, are you here with us?
I'm here. Hi, Jeremy. Hi, Michael.
How are you?
Good, thank you. Thanks for organizing this. It's always a pleasure to be with Flya, and hope that all the people who are watching us are keeping safe, and the best wishes to everybody. Thanks for the time to being here. So one of the things that I like to transmit when I start talking about workforce housing is resiliency, right? And my investors ask me always, why are you so sure about this asset class? And it was all started in 2008 when we started buying single family houses. One by one, we were able to assemble a portfolio of about 400 single family houses and 400 small multifamily doors. And I was the one initially with my partners. We were buying them, we were fixing them, we were very, very operational. And as part of that, we were property managers. And we were collecting rent and sometimes, being the front face of the eviction party. And we saw how important the roof is for a person. I believe that housing is more important than food. People will do everything in their power to keep their roof on top of their heads. Foods, you can go into a soup kitchen, community supermarket, you will always get food for free. But no, there's sometimes things that, people talk about shelters, they're usually full, and sometimes it's very hard to get shelter for free. And we have seen that, and we've seen how rents behave very, very well, even in the worst of crisis. And obviously the worst of crisis was not COVID, as we think, thankfully it was not. It was 2008, 2009 to 2012, 13, where the government basically let the economy go down to where it went. So for me, resiliency is the key component of workforce housing. And we're gonna talk about what we look when we underwrite workforce housing and some of the things that we have seen. So again, I'm very open. Feel free to ask any question. So let's start. I have some slides that we have prepared. So again, I already talked about our company. In 2018, we sold most of our portfolio, single family and small multifamily. The single families we sold to Cerberus out of New York, First Key, and we pivoted to large multifamily, frankly, because at that point we did not see any more upside in the single family space. We were wrong. We wish we had the crystal ball, but again, back then it just didn't make any more sense. The cost of capital was very expensive. Managing single family was very expensive. Thank God, eventually the market saw the potential in single family and lowered the cost of capital. But then what we did is we pivoted to large multifamily in an institutional way. We created a very robust team of professionals with a lot of experience in this industry. And what we're trying to do is we're trying to underwrite properties that will have a 7 to 8% cash on cash after fees and about a 15% IRR 5-year, which is basically 2 times multiple. We do that by acquiring properties and then creating the equity stack using special purpose vehicles. We bring people who are our investors, who were our investors into these SPVs, and we're also always talking to new investors. And so if you're always interested to invest in this type of deal, feel free to reach to us. So why PIA Residential, again, you guys can read there, but basically, we know what we're doing. We're hands-on, and we have this institutional mindset for us. It's about conservative underwriting. And that is very important for us, and sometimes to a fault, where we really are sort of thinking about what can go wrong. And so we try to not, take additional risks for sometimes generating an extra point of IRR. We believe that right now the market is very, very tight, and taking additional risk only means putting equity at risk, right? That doesn't mean that you're going to get a higher IRR for free, right? And for us, so that becomes like the number one thing that we do is we're very constrained by how conservative we are, by the way we analyze things. We have a team, everybody has their own different opinion. And this mindset of, thinking as an institution, but also with an entrepreneurial spirit, I think is key to our success. Again, our investment thesis is simple, right? We, first of all, believe in who we are and our experience. And we believe that through the 15 years that we've been in real estate, each one of us, so, collectively, between the people that we brought into our team, we have more than, 100,000 units between people who bought and sold and managed and, did asset management and financed. And I don't think that we've seen it all, but we have seen a lot. And we make that part of our key decision, is what we believe it's core to what we're going to invest. And that is checked by obviously everything that we have learned. And, along with the people that bring experience, we also have consultants that bring their side of the business, right? And you will see in an underwriting criteria how we do this. So again, for me, the workforce housing is the key word again is resilience. And I will keep on saying it again, but there's several things that we look for that gives it that resilience. First of all, it has very strong fundamentals, right? When you look at workforce housing, you're looking at, decent cap rates that are sustained by rents that are market in a way. You're not really pushing rents beyond what people can pay, although people will talk about rent affordability. Sometimes that rent affordability can be defined as, oh, they should be charging $1,100 instead of $1,150, right? And so it's a $50, difference. I don't think it's much, versus some markets where the rents, like in A class or in A class, in really nice neighborhoods, rents can be $3,000. In our neighborhoods, the rents are $1,100. So, it plays down to the blue collar force that it's always going to be there, always going to get paid, right? And that creates risk mitigation as far as cash flow is concerned. And for us, the most important thing is that we have that, quarterly payment to our investors. That is very important for us, and that comes from operations. And we understand operations very well, and we understand what the risks that are present in those operations, and we know how to mitigate it, and therefore we can forecast very well that the operations metrics, and we feel extremely confident in what we can provide as cash on cash to our investors. And for us, that is the number one case that we put in front of our investors is you're getting a quarterly dividend. And not only that, but it's also tax advantageous because of the depreciation it's used. In addition to that, workforce housing has the additional advantage is that it's in a way subsidized by the government, because you have Freddie and Fannie have mission to lend in this space. So you have very good agency debt, that it's a long-term agency debt that can help you mitigate any risk that comes from inflation. And also equally important is what I call the agency put, which is when something happens in the market, you can call the agencies and they will help. And nothing, it was very, very clear during COVID. When COVID started, I remember that in March, we're like looking at each other and saying, how many people are not really going to pay their mortgage? I'm sorry, their rent, and, are we going to be able to cover the mortgage? And, within a couple of weeks after everything started, we got a call from our servicer saying, no worries, guys, the government is here to help. If you have any issues, we understand and we are willing to accommodate. And that is huge, right? Because if you think about it, when you buy assets and sometimes you might have the risk of losing the asset and therefore all the equity that you put in because of black swan event. And in this case, a black swan event happened and the government came and said, no worries about it, we're here to help, which in some cases, it's very helpful, right? The other thing that is happening in workforce housing is that it's very it's the same cost to build class B than class A in a way, even class C these days. I mean, it changes basically very little. And so a lot of people are saying, you know what, if I'm going to build class B, I might as well build class A. Maybe I have a better return on that. And so it's very expensive to build in a way. And so there's a supply shortage of workforce housing, right? And a lot of the workforce housing, what happens is that it's in the urban areas. It's older buildings that it's in the urban areas. And so, finding land in urban areas is not so cheap either. So I believe that the supply demand imbalance in the workforce housing is still going to be there for many, many, many years to come. I don't think there's going to be some sort of technology that will change the idea of a place to live. Like, now we have an issue with the offices or the Amazon effect, right? I mean, everybody's saying, well, we might not go back to the office. If we're not going to the office, we're staying at home, which means that, our house, our roof, the place where we live becomes even more important. And for those of you who actually want to learn a little bit more about it, I'm writing a book about the effects of technology in real estate. And basically it's based, the theory there is that there's a lot of technologies that will affect real estate, for example, like the Amazon effect, or right now work from home. But all those sort of technologies, very little are going to affect the residential side of the commercial real estate equation. So what do we do when we look at a property? First of all, we underwrite about 500 properties per year. And it's a lot. We do, it's a funnel, it's a back of the envelope type of thing. And, for that, we're basically connected with all the brokers and, all the properties that hit the market that are of interest. And, we have a lot of horsepower behind that. And we look at the Southeast of Texas. And once we start looking at a property and said, well, you know what, this doesn't really make that much sense. We take it out of the back of the envelope. If it starts to make sense, we put it in the middle dive and then, we start throwing some time into it. And if it makes a little sense, then we put in a deep dive. And then that's where everybody sort of joins forces and start looking at things. And then we issue an LOI and then we try to start really competing for it. But there's a lot of things that we do for us to get there. Not only we look at the market, which is very, very important, but how many of you, when you underwrite something, are looking at the bond market of that municipality? So for us, it's very important to understand how that municipality is doing. And it seems basic, but a lot of people don't do it. I mean, you really don't want to invest in a multifamily on a municipality that's about to go bankrupt, right? You might have some bad effects on, 2-3 years from now when they start cutting police and, the workforce, what happens there with the government people and the whole thing. So then we do the rent comparables. And for us, it's very important to understand the dynamics of what is happening in the rent in that market. A lot of people say, well, you know what, the rents are going up, but why? Right? Why is it going up? I mean, what type of tenants we have in our property? Is it mostly people who are working for the government? Are they working for a factory? Is the factory going to be shutting down? Right? So we start digging really deep into it and really try to understand where is the type of tenant that are coming to our properties and to other properties. We call the biggest employees in the area that actually affect the economy of the area and start asking them questions. We asked to talk to about their, public relations office. How long, what are your plans? Are you plan to grow? Are you plan to expand? We try to look in their SEC filings for any sort of indication that that factory in that town is no longer going to be viable. And so we really take it deep because at the end, that is the responsible thing to do when you buy assets that are worth 30, 40, 50, $60 million, right? And then we get into the nitty gritty of, how much can we raise the rents and why, right? Is it because, oh, you know what, in front of our property that we're analyzing, they changed the appliances to stainless steel and they're charging $100 more. Can we do the same thing here, right? So we don't speculate with things. We're like, you know what, if we see that somebody else did it and it worked, we will probably do it and we'll take that into our model. But the whole thing where a broker tells you, oh, you know what, if you change this for that and you put stainless steel appliances, if you make the dog part instead of square, you make it round, you can increase the rent, and nobody's done that before, then we're probably not good for that sort of economic thesis, right? So we really get very, very deep. And once we put it under contract, that's when the fun starts, right? Because then you have to do all these audits and really understand. And the problem these days is that you have to be competitive. In order to be competitive, you put properties under contract with no due diligence period. So you have to do a lot of intelligence, market intelligence before that. And we really commit a lot of resources, time and money to do that. Obviously, we travel to the area, we walk every comparable, and we put a lot of, I will say around 100 to 200 hours just doing that when we're actually bidding for a property. Now, again, when we look at a property, what are we trying to look, right? So is there an embedded upside? And by that, I mean, is that bad property management? I mean, right now, even the best managed property has lower rents because the market rents have grown so fast, right? Can we get a good rate from the bank? I mean, from the government agencies. Some properties you might not be able to do that. Just they're in a market where rents with the debt is not so beneficial, right? Do we see population growth, and why, and where is that coming from, right? How hard is to not only listen. It's very easy to say, you know what, I'm going to walk into that property, I'm going to start changing all the kitchen cabinets and painting and doing all this thing. But right now the biggest issue is labor. So it's not only does it make sense to do it, is can we do it, and can we do it on time, right? One of the biggest issues that we have right now with underwriting is that, hey, can we do this thing in 2 years? Yes, we've done it before, but can we do it under current conditions in 2 years? And that's that's one of the things that we look for. Obviously, for us, replacement cost is kind of a pet peeve, right? We look to be at a decent price per pound. We understand that there's people who are probably building new, and the last thing that you want to do is buy a property at $200,000 per unit, and somebody's building something brand new at $230,000 per unit, right? That's not really competitive when you look at it, in 5 years to sell, right? You have to really think that a lot of the return, it's coming from the 5-year sort of forecast, how much I'm going to sell this property in the future. And so you really have to understand the dynamics of, how many properties are being built, how hard it is to attain construction permits, is there land, what is the cost? Sometimes it's easier to build in large cities because you have a lot of construction companies than in smaller towns. Kind of counterintuitive, right? You might say, well, in smaller towns, there's more land, there's less competition for it, but it's very hard to build. There's not that many people who are actually in construction, right? So we look at all those things to really feel comfortable with the fact that we understand very well the property, we understand very well the city, and we really, really believe that there's some upside, and we understand the reason for that upside. So we just don't swallow whole when a broker tells us, that the thing can go up, right? We just go deep into it. So for us, that knowledge that we have, the context that we have, the way that we underwrite, right? Then we bring our own sort of brand to the table, right? We do not have a property management company. And one of the reasons that we don't have a property management company is because we were property managers already. We managed 400 single family houses, 400 small multifamilies, all here in South Florida. I will challenge a large property management company to really come down and really understand how to manage 400 single family houses. Very few people can do it efficiently, right? And so one of the things that we learned is that, there's people already managing 50,000 and 100,000 multifamily units. They can do it best, Not only they can do it best, they will have access to better people. They will be able to recruit more talented personnel. But the most important thing is that if we don't like them, we fire them. So there is a very straight sort of relationship between the property management company and the owner of the building, and we're very, very good asset managers. So we concentrate our energy in being an asset manager. I think that the property manager does what they do very well. They have the systems, they have the people, they have the infrastructure, and equally important, they have the knowledge of other properties around the area. So when we're looking at a property to buy a property, what we do is we look for that property manager who knows that area very well, and we bring him into the process. Equally important, by not having a property manager, guess what? Property managers approach us with properties they're currently managing that are selling, and because we are going to hire them most likely, then we have some sort of interesting information from them. So our idea is to create a strong return profile based on conservative underwriting, right, and on very deep knowledge of the product that we're doing, and we're partnering with people who can do it best. We understand that that is the key to creating a product for our investors that can give them the tranquility that they will have the returns that we are promising in the future. And again, we always want to under promise and over deliver, and that's why we believe being conservative, it is in line with what the market wants. So again, where we do it basically is the Southeast in Texas. The way we look at it is, it's taxes, sun, migration. Every sort of state that has positive migration is very interesting. You got smaller cities that you never thought that they were going to have that amount of migration to them. And I think that when you have markets that are growing, even in the darkest times of recessions, when people have a reason to migrate to that market, you have already an advantage. You don't want to be into markets that are, getting reduced, or where there's a potential where the cities are not going to come out of a bad situation. So we like those markets. We specialize in those markets. And again, so far we bought mostly in Florida, in Pensacola and Jacksonville. We're buying one property in Savannah, but we're always looking for opportunities, and we're looking at opportunities in all those submarkets. We have a track record. We have a great track record with the single family trade that we did. We also have some track records on the small multifamily, and I wouldn't call it that small. I mean, it was, some of the units there, Willowbrook was 76 units, and they had 40 units, 60 units, our single family portfolio. That one that we sold, we sold for, we bought for $60 million, we sold for $50 million, right? Those were the times. But again, the funny story about that is in 2009, people thought that that was still expensive. So, we've been at it for a while. We experienced a lot of pains. We grew, we understand operations, we understand the downsides, we understand how to work in challenging environments. We got the scars to prove it. So, our track record, I think, speaks for itself, but equally important, the returns that we offered our investors and that have been delivered, it's a been proof of that. So these are the properties that we have bought. That's Crystal Lake in Pensacola. It's 224 units. We underwrote for 11% cash on cash and about a 15% IRR. That's after fees. That's net to investor. So far, we are close to that. Again, the challenge there was that we not only had a hurricane, but we had COVID in the middle. And I am proud to say that, we're, like 95% there to that number. It has been challenging, and, that's just basically a proof of what we have done and the ability that we have, the ability that we have in order to respond to challenging situations. We should be exceeding that by the end of this year. So we're good on that. If you want to get a copy of our offering memorandum, again, that's subscribe. We're not trying to offer anything to anybody, but just for educational purposes, you will have a link where you can download it. St. John's Point, the same thing. We underwrote a cash on cash of 10.8. and an IRR of 14.25. We're way better than that right now. I mean, Jacksonville has been an amazing market. When we underwrote and we bought this property in the middle of COVID, we put some COVID reserves, and then Freddie and Fannie asked us. I mean, this was a Freddie loan. Freddie asked us to put a reserve. I'm sorry, it's a Fannie loan. We put a reserve on the side for COVID. We didn't touch the reserves. I mean, the market is behaved spectacularly right now. We're like 99% occupied, and we're way above what we promised. Again, you can download the offering memorandum on that for purposes, for instructional purposes. Sterling Bluff is the property we're closing right now. It's fully subscribed. We're not soliciting. This is not a solicitation call. Again, this is something for you guys to see what we do. The IRR is 15 plus, and the cash on cash is close to 7.5. And this is an amazing market. I mean, I didn't know that Savannah existed, and I went there, and it's just very cool city. Not only very cool city, but it's very dynamic, and it basically proves that our acquisition department and all the work that we do just pays off. Sometimes it's very frustrating when you underwrite that many offers, that you underwrite that many properties, and write that many offers and go visit that many properties. But this is an amazing opportunity. Most, if not all, of the comparables around there are to like 99, 100% occupied, and the embedded upside that we have here, it's just amazing. So you will see, I mean, the executive summary on Sterling Bluff. We like that property because it's not only close to the there's an Army Air Force base right there in front. It's an excellent look and feel of that property, but equally important, it has very good visibility, and it has good upside. We believe that most of the rent pops that we'll obtain in there will probably exceed what we underwrote. And I believe that that 173 number, it's looking more like 250 to 300 right now, and the market is just packed. This when we underwrite our properties, although most of the times we're doing this for I mean, we don't do it to go out to market and sort of raise the money, but we create a very detailed underwriting memo for ourselves and for our investors, because we believe that in doing that, we have to generate some sort of consensus between us on what the numbers look like. And the perfect is the enemy of the good, and sometimes what we do is to just battle it out, right? Every number that we have there has a expert associated with it, right? We hire people to tell us what the taxes are going to be. We hire people to tell us what the insurance is going to be. We hire people to tell us what the estimated maintenance is going to be. So we try to mitigate those numbers as much as we can with talent that knows that sort of line very intimately. We work with the property management partner that we engage from day one, and we try to come up with a budget, and we try to be very, very diligent about those numbers. So when you asked us about why do you think the taxes in this case will probably jump from 220 to 442, they double because the property basically had was purchased at a very low cost base, and that number is given to us by an expert. The insurance number, we hire insurance experts. It went from 118 to 132. That an expert comes and says, you're underinsured here, you should be taking care of this. And we do a lot of the things. In this case, in this property, the current owner was spending too much in marketing, and we believe that that was something that they were doing in-house, and we can do with our property manager much better. And so you'll see all these numbers, and there's every number in there has a story, and we're very detailed when we write. One of the most important things that we have in our models is that we like to see what is called quality of IRR. A lot of people talk about IRR, and my background's in finance, and I can tell you IRR is a very complex. It's an easy number to explain, but it's a very complex number to attain because it's elastic to a lot of inputs, right? And so because the way that we look at IRR is that it's an uncertain future, it's a number of an if an if. What we like to is to look at what the operations yield, right? And in this case, we like to see the operations cash flow basically having a substantial impact on that IRR. So it doesn't become like a development deal where you have no cash flow and then everything happens in the back. And so that quality of IRR, we're looking to be 40, 60, on the operation side. Certainly in this case, you'll see that it's 42, 58, which basically complies with what we have. In some cases, it's 50, 50 because of the cash flow being so high. Right now, these days, it's very hard to underwrite with so much, embedded upside in the properties. I had a phone call from a family office that said, we do not believe that your rental income is going to be able to increase by more than 10%. I mean, you can see it. The rental income goes from $2.6 million to 2.8. It's like a 6 and some percent. And they're like, I don't think that's a believable number. I says, yes, you're correct. It's not a believable number because the number is more like 10. I mean, the market is so tight and the rents are going so fast that how do you underwrite that? So we go back again. We're conservative. What do we think it's a safe number to put in there? What happens if the market stops, right? And so we're trying to get to a number that it's in a consensus, and to have a consensus in our team sometimes is very difficult. It sounds easier than it's done. But at the end, we end up with this model that is very conservative. And the model that is very conservative basically shows here. So if you're underwriting a property and somebody talks to you about IRR, look at what the IRR is coming from. And a lot of the IRR can come from secondary financing, right? Somebody gets a bridge loan and then it replaces that bridge loan in year 2 or year 3. Not here. It's a 10-year finance. We keep the loan for the first 5 years. You have to understand where that cash on cash is coming from. Some people talk about, oh, it's a 9% cash on cash, 10% cash on cash. Really? But what's the average, right? So some people, they really use financial engineering and their underwriting just to juice up the numbers. But be careful, because when financial engineering is used, you have to account for risk. And that is the thing. Be very aware of what financial engineering is used in the capital stack. People right now are using preferred equity and they're using bridge loans. So just, shy away from those type of deals. We're, middle of the fairway, very conservative. Our mission is to preserve the capital of our investors, make sure that we give them a return that is predictable, it is safe. We understand that that is what we do. We don't take risk. We don't take unnecessary risk to get there. So the business plan, of course, for a property like Savannah, right? It just basically write out the eviction moratorium, start bringing in people, renovate the units. Nothing different than a value added in a light value add. And I say light value add because light value add requires less risk. And when you have a deep value or a reposition strategy on a building, be careful. That's a lot of risk. Deep value, you're basically assuming that you're redoing the whole building. Basically, it's a general contract. It's a construction job in a way. So we're the light value, reducing risk, right, and trying to upgrade the units as they move out. Also, on the understanding that our asset manager, it's really trying to understand whether it makes sense to actually renovate the unit. Sometimes you underwrite the unit to be renovated, but if you increase the rents without renovation or just by simply changing the appliances, we'll look at that. So it's not, a business plan is a business plan, but it gets coordinated by the excellent asset management group that we have, that they're almost in a weekly basis with the property manager on top of what's going on, what's the best way to implement. The market analysis, in a property like this, the reason we like markets such as Savannah, and there's a method here. I mean, Pensacola has a military base, Jacksonville has a military base, Savannah has a military base. They're port cities. I mean, more Jacksonville than Pensacola, of course. They have positive migration, they have sun. Yeah. We strongly believe that, cities where you have infrastructure that it's key to the operations of the state, it's important, right? The port of Savannah, it's an amazing port. It will be there. It just basically, it's a corridor to the biggest economy around there, which is Atlanta, in the other cities around there, and that port is going to be there. So I think that gives that city a resiliency. In addition to that, you have tourism, you have people coming in. So one of the things that we look at for is, what is the, again, go back to the resiliency word of the city and the property that we're investing in. Again, the asset class is resilient, as I already said, right? You will see this. We'll look at, what are the population around it, what's going on, what is the trend, what is the average income, right? If you're charging $1,000 for rent and your average income is $60,000, that's, it's pretty cool. You more or less have to follow a rule of three, right? Which is your rent shouldn't be more than 30 to 40% of your income, right? And that's the beautiful thing about working class, that in most cases it doesn't exceed that. We do, we get very deep. We, not only you will see a rent comparable here, but we actually walk those comparables, and we do everything, with it's basically boots on the ground, right? So why Savannah in this case? We believe a market that it's going up, that is resilient, that has an economy that it's still going to stay there, that it allows us to create a very good story about the property that we're buying, that has embedded increases, right? In that, it has proven potential with the upgrades that we can do. It has good employment, good dynamics. And so when we're underwriting a property, again, it's all this as a package. There's not one thing that makes it, right? I wouldn't say that, there's a couple of things that might not make it. Price per pound being one of them, right? Decreasing population being one of them. But, the group of everything that we're seeing, it makes us feel comfortable, so comfortable that when we put these properties under contracts, we're hard on day one on in most cases on their LOI, not even on PSA, we're hard $500,000. So we have a lot of experience. I mean, I'm sure you can get to our website and see our faces and our resumes where, we've been doing this for a while. The people that we hire have been doing it for a longer time that we have. We like to hire people with, very good experience. As you see, so with no hair or with gray hair. Ron is the only young person here that actually has black hair, actually has hair. So in conclusion, people ask me, so what's your thought on what's going on with the economy? I'm like, I'm not an economist. I don't want to be one. I don't want to play one on TV. But what I know is this, is money has to be placed somewhere. And I want to place my money in a situation where, it doesn't evaporate, crypto, whatever, right? With the sort of jumps in the market, are, not that bad. I mean, I'm not an equities guy because I think that in some cases, you're sort of betting on a market that it's inflated. For me, if I can, buy a property that can give me an 8% cash on cash, for the rest of my life, I'll be happy with that. If that 8% cash on cash, it gives you, it's tax efficient because of the depreciation that those properties give. In most cases, you end up paying no taxes over that income. And then if at the end of those 5 years, you can sell the property for more and, make that 8% cash on cash into a 15% RR, I think that's a spectacular opportunity to deploy money. But more than the opportunity, it's important also to look at the team. What's their experience, how long they've been working together. It is not the same when you put 3 people that know a lot in one room and they have 1 year working together, that when you have 3 people and their team that have been working together for many, many years, for decades in the room. It's Sometimes it's about the execution of that team and their ability to work together and the ability to coherently underwrite things. And equally important, to be able to prove themselves when the times are tough. Because again, times will be tough eventually. So if you guys wanna, feel free to call me. My phone number 305-803-5956. That's my cell phone. My email, danny@piaresidential.com. If you guys want to talk more about investing with us, you can go to our website, fill there a form, and we should be able to talk in more detail about how to invest with us. And if you have some ideas about other things, we'll be glad to talk to you guys.
So
how are we
Danny,
doing time, Jeremy?
Oh, we got about 20 minutes and we got several questions. So are you ready to answer some?
Always ready.
All right. So Sabrina says, do you ever encounter backlash from a program that contemplates raising rents through value-added repositioning for a renter cohort that is already cost burdened?
Well, again, there's a lot of things that happens. So there's a cohort that it's cost burden, and I basically, that what's going on right now is that there's no supply, right? So if you think about it, the people who are in class, and this is the beautiful thing about class B in workforce, the people who are in class A who cannot afford class A because right now their cost burden there, they're gonna come down to class B. So there's always going to be people coming to your asset class. The question is, does it make sense for me to have vacancy and generate $100 more per month, or do I just basically renew that contract for an extra 25? And that's where, the asset management, it's very important. Property managers, sometimes they will do what the computer tells them. And the computer, obviously, it's not intelligent. They're paid to keep the properties full. And as an owner of a property, you have to be sometimes very comfortable with the concept of vacancy. And I learned this with the single family houses, right? When we started buying, it's like, let's, heads in beds, keep them full. And at some point, we're like, wait, hold on. Sometimes we're putting these properties in the market, let's say for $1,500, and I have it rented within 3 days. What if we ask more, right? How do we know what the real rent for that is? So we started saying, let's ask $1,900. And we're comfortable with 2 weeks worth of vacancy. And sometimes we got those numbers. So it is a very fine, increasing the rent, knowing what your market can afford, and knowing what rents can be paid by people who are not your market, who might be coming to your market, right? And it happens here in Miami, right? You got all the New Yorkers coming, and now rents are higher because they can pay those rents. One of the guys that works with us, had been looking for an apartment for a month. The rent just went through the roof, and one will never think that people will be paying $3,000 rents and rents that were $2,000 just a year ago. So the question is valid. And again, the way we do that is with a lot of analysis and a lot of the experience that our asset management brings to the table, which has decades and decades of experience in managing tens of thousands of units.
Okay, next, what sort of data informs your conclusions that Class B/C tends to outperform during economic recessions? My observation throughout COVID has been that the majority of job loss occurred within buckets of Class B and Class C tenants.
You know what? Again, there's a lot of statistics out there, but let's just use common logic, right? Class B and C tenants got fired from their jobs, but also the government came and said, here's a check. They have unemployment. Class A tenant loses the job. It's much harder for that professional lawyer to go find another job that pays $150,000, right? A Class C tenant that maybe they're a cashier in Walmart, it's probably easier to move to be a cashier in Target. So I really think that nobody has really proved anything different than that. But if we use the common logic, it's Class B and Class C tenants, workforce housing, it's workforce. you're not going to be outsourced to India to be a lawyer there, or if you're a programmer, you're not going to be outsourced to Latin America, right? I truly believe that when you are catering to people who have to be here and they make their living by, working with their hands or presently working or, being just basically a worker bees, that is more resilient. What I saw when I was buying houses and when I was collecting rent and I was, knocking on doors to collect rent, was that sometimes people could not afford the rent because of mismanagement of their finances, not necessarily because of they didn't have a job, right? A lot of those people that somehow lose their job, they have plenty of state and local entities that will help them while they're getting a job to pay their rent. And it's easier to get help to pay a $1,200 rent than to pay a $4,000 rent.
Okay. What's your opinion on long-term hotel conversions to multifamily workforce housing? Are you seeing an uptick of this in the market?
So people talk about hotel conversions. I go risk, and then the light starts flashing, right? So basically, you're getting into a construction job, right? And let's think about that, right? I can go buy a multifamily that is stabilized, right, with agency debt, probably at 70%, 3.25, 10-year fixed, right? And I can make my dividend from month one, right? People who invest with me, they get a quarterly dividend check, and I can tell them what that dividend is going to be more or less from day one. If you are a investor that is going to invest in that hotel conversion, now you're getting into a construction job that is now also sort of complicated by the amount of permits that you have to get from a city. And trust me, I serve on a planning and zoning board of the city of Hallandale, and I can tell you that sometimes cities are getting complicated, not because of the city itself, but because people are not showing up for work, right? And on top of that, once you have this hotel converted, right, now you have to go and lease it up, right, to what I believe it should be a rate in the market. That's okay. But then what happens in the middle? What happens if your GC basically taps out and say, you know what, I gave you a price of X and now it's 2X, right? So I think that there's a lot of risk. And when you look at the result, it's kind of like, too much squeeze for so little juice. And yes, maybe you might end up with a better price per pound, but let's remember that in the meantime, the equity sources and the debt sources that you had there were very expensive. In most cases are recourse. And you might, if you don't implement that plan, you might lose the equity because, you couldn't get, the hotel sort of converted and occupied. So I'll just be very aware that, that conversion it's a development risk. Might as well just build from scratch. At least you have, a lot of sort of industry experience. People can tell you, merchant builders, and you have, bank programs dedicated for that. So I don't know. I've heard a lot of people trying to do it, and I think they're pushing the envelope. I'm more on the safe side, where if you want higher returns, is because you're assuming a higher risk. It's on to you. We like lower risk and equally good returns.
So I got a piggyback question
Sure.
for that from David, which was, would you consider new construction in select markets?
You know what? Again, new construction is risk. And one of the problems that I have with new construction is that you have so many risk factors going in it, right? But the biggest issue that I have right now, it's inflation. What's going to happen with inflation? Everybody says it's temporary. I don't think so. I mean, I remember when I was in university, a slice of pizza was 25 cents. I never seen it back at 25 cents. It's for me, in my mind, I don't think that, there's going to be, a deflation part, right? So prices are probably going to keep on increasing. Then you have all this issue with job, right? How many people want to be baking in the sun swinging hammers? right? And on top of that, you got all these deliveries. And then let's assume that you can actually get the land and you can get the permits on time and you can get the materials on time and there's no COVID-3 or another hopefully not another thing that basically grounds us, right? And in 3 years from now, you're able to deliver that property. And then now a black swan event happens because I don't know, something happens in the financial markets and the economy grinds to a halt. Okay. So you're an equity holder in that, and your bank is saying, knock, knock, I want my loan paid, it's 3 years. So I think that the problem of development is that the downside of development is too ugly. And in some cases, you might lose all the equity. So if you're really doing this thing because you're going to have an IRR of 20 instead of 15, right? And by the way, it's not tax efficient either, right? So I always question myself of the people who are developing, and they're developers, they always do well. When they don't do well, their equity doesn't do well, but they still make their development fee. So I don't know. I think it's a little bit asymmetrical. And at this moment, people are saying, well, if I'm going to buy a property, let's say $150,000 per pound per unit in a 1980s property, might as well develop something for 200. It's more 250 these days. It's probably going to take him 2 to 3 years, right? And God knows what's going to happen in 3 years. So just for kicks, think about that developer who had their CO in January of 2020, and they're starting to fill the property, and then COVID happens, and then everything runs to a halt. What do you think their mind was? They were very, very scared, right? They were thinking how much money we're going to lose here, right? How am I going to pay the bank? I don't want to be in that position. I don't want to put ever my investors in that position.
Okay. Do you accept 1031 exchanges into the syndication, and do you engage in cost segregations?
We do engage in cost segregation. We think that it's very, very important. The 1031 exchange, I think that there's a method where they can invest with us in a 1031 exchange as a 1031 exchange. And so we have not done one, but funny enough, before this presentation, I was with a 1031 exchange person that specializes in that, and they had an investor, and he was telling me that he was explaining how it's done, and I think it can be done.
Okay. Does PIA typically tackle its property upgrades immediately upon acquisition or as units turn? The ULI definition for workforce housing has been posted, but I'm curious where in the 60 to 120% AMI spectrum PI typically operates.
Well, we like to be market rent, right? So that's one thing. We believe in market. We did a lot of Section 8, and Section 8 is a necessary program. I endorse Section 8 as a program. I think it's necessary, but we're not a Section 8 type of player. We're not a below market rent type of player. We're market rent. We believe in market forces, and that allows us to sort of take advantage of the market. As far as the units, nothing spoils a plan as much as contact with the enemy, right? And so you can have your plan on how to attack things, and then you have your first contact, and you change it. And so the first thing that we do is we go into a property, is we do a test unit. And that test unit allows us to sort of really understand the mechanics of upgrading the unit. Do we have to move outlets from here to there, and so forth and so on, and what is the cost, and what is the providers? And then we start engaging the contractors, right? And we'll see, once we finish sort of that test unit, we said, well, we think we can do it for so much, right? And we think that, this is the contractor who's going to do it. And then we also find out the problems, right? Hey, we were going to change the kitchen cabinets. And I remember in Jacksonville, we changed the kitchen, and it turned out to be that when you're going to open one of the cabinets, it couldn't open because it was next to sort of the dryer or something like that. That's how you get the kinks worked out. And then you put it into market, and you say, hey, how much people are willing to pay for it? And then, you get a data point. And then you do another one. And then you do a data point. And then once you have really good data points, that's when you start sort of implementing the, hey, you know what, let it rip. We're spending, an average $1.5 million on these upgrades, right? Between the outside of the property and the inside of the property. We want to be very tactical about it. we want to be responsible about it. I mean, I think that, if you had the magic button and just, push the button and, everything is upgraded, and it turns out to be that you cannot rent them for what you thought you can rent it, that would be wrong, right? I'd rather say, you know what, we thought that we can upgrade them. We thought that we can increase the rent, and, we couldn't, and return that money, then deploy the money just because we have it.
Okay, we got 2 more questions.
And by the way, what we're trying to look is a return of 4 times what we invest. So if, let's say we invest, $10,000 renovating a unit, then we have to increase the rent by $2,500 a year, $200 per month.
Okay. What's the trailing cap rate on Sterling Bluff? Also, what are the market drivers other than the base?
So here's the problem that we have with trailing cap rates. One, they're highly affected by bad management, right? So the question is, what is the cap rate of a vacant property? Negative. Will you buy a vacant property? Yes. How do you underwrite a vacant property? You said, well, you know what? Once I stabilize it, this is my cap rate. I wrote an article about what a cap rate is, not a cap rate. You can Google it. I wrote 3 articles in Forbes, and one of them is when a cap rate is not a cap rate. And I talk precisely because of that. A lot of people tend to emphasize cap rates, and cap rates, I believe, in most cases, they have to be put into context. The trailing cap rate, I believe, on Savannah was, I think it was, low 4s, even I think it was below that, because you had a lot of issues with collections, right? And that had to do with the moratorium. And we knew that the moratorium was going to end, right? And so how do you underwrite that? Also, the rents are going so fast. If you think about this, even in the best managed property, if the rents are going by 10% per year, you're going to be 5% below the market rent, right? Because, you're turning the units and you're bringing to market rent, the one that was 12 months old, 11 months old, still, 10% below that. So you have to also be aware that at this moment, the trailing cap rate might not mean that much, because rents are going up. And if it's badly managed, in the case of Savannah, right, we found some things that, we believe we can do it better. I'm not saying that the current manager was bad or good. We said we think we could do it better, right? Again, that's, not that we believe we can also do it better, but the people that we partner with, told us this is how we do management, and this is, we have 50,000 units that we manage, and we believe that these are the metrics. And so you're always looking for that sort of edge when you're looking to a property. Can you actually bring something tangible to the table where you can do something better with the project, right? And like with everything, right? Different perspectives.
Sorry about that. So last question, and then if you can kind of do a closing for everybody. What is the IRR minimum investment and hold period?
The IRR minimum investment, I don't understand that question. I mean,
what's the IRR, the minimum investment, and the hold period?
Okay, the IRR of we're trying to underwrite about 15% IRRs, but then again, we're seeing that challenged a lot because of the price per pound. So I think that probably will settle around 14, and again, how do you get to that IRR? It's equally important. We do it by, we get there by not using financial engineering. So IRR is meaningless unless you understand what is the financial engineering behind that, because it doesn't reflect the true risk, right? The minimum investment, we basically, most of the people who invest with us invest, at least $200,000, right? We can start looking at programmatic relationships below that, but, it has to be something that, that will make our while, with individuals that are really, testing the waters. We underwrite for a 5-year hold period. We believe that is a fair hold period. It allows us to execute our plan, and it gives us enough time that if there is any blip in the economy, we can dispose of that. Our documents allow us up to 7 years. Again, our intention is not to flip anything. Our intention is to hold long-term. So 5 years to 7 years depends what 5 years, some people call 5 years medium term, but yeah, that's our intention.
Okay. Was there anything else you wanted to cover?
No, listen, I think that we can, certainly speak for another hour about this. The message that I want to send investors out there is just be careful. more science fiction has been written in Excel than in Word. I believe that if you are looking at a project, not only just look at the numbers, is look at how the numbers are, structured, where they're coming from. Capital stack is a key to underwriting a property. Find out, what are their underwriting capital stack, what financial engineering they're using. But equally important, all the numbers are meaningless if behind those numbers you have a team that is not experienced or doesn't have like a good sort of intention. It's just, hey, let's put a number, people fall for it. They really don't question that much. One of the things that we are proud of is that our investors are institutional in nature, large family office, high net worth individuals. So when we produce the documents that we produce, behind them, they have a team of analysts that are literally underwriting what we underwrote and trying to figure out, whether we're telling the truth or, I'm not telling the truth, but we're being honest to the numbers. As I said, there's always some kid in the back of an office trying to figure out if we did a mistake. And so we're very, very detailed and very professional about what we do. And equally important, the second aspect of investment, and please do not forget about this, is you're going to have to sign a subscription agreement. And that subscription agreement, in our case, is institutional in quality. The people who sign that are, high net worth individuals, family offices, institutions that are requiring certain, how do you call it, writings in that. And so when people invest with us, they have, I believe, that advantage is that they're investing in sort of an institutional environment, with a group of good professionals who are looking long-term into asset preservation in a conservative basis.
Thank you, Danny. This has been great and very informative. Your email, you provided it before. Your phone number is on the screen. And if anyone has a problem getting in contact, they can contact us and we will get the information to you. Thanks.
Thank you very much.
Thank you so much too.
Thank you for everybody for attending, and have a blessed day.
That completes this webcast.
Thank you.